So the next thing is to do exactly the same with a slightly bigger stock universe. And then see whether we actually need all those factors. So let me do that. And then we might stop and think a bit about whether you have questions or so. I stayed in a very similar situation, also the same time frame. But what you see now, instead of just taking 5 stocks, I have now singled out 16 stocks. So on this slide, you see 16 stocks from the Dow Jones universe. And if I now look at these 16 stocks over my period, again, you see in that third column, you see the returns, the net return of this 5-year period. And here you see the annual volatilities. Some have a very high volatility. I mean, when we look at American Express, very high volatility. Bank of America, the highest volatility. So you probably realize, oh yeah, JP Morgan, 51%, right? This is the credit crisis. That's why these volatilities are so high. And you see some blue stocks. The blue ones we already kind of encountered in the 5-stock portfolio. I now do exactly the same as before. So what does it mean exactly the same before? I go on the search for factors. So I will again ask in a mathematical way my system, instead of these instead of these 16 stocks, please give me 16 uncorrelated factors. Each factor will be a portfolio of these stocks. So I do that. Well, I do that. And then what I also do later, I will also look at the portfolio. So instead of just looking at the stocks, I also look at the portfolio. And the portfolio, I choose a very simple portfolio. I choose an equally weighted portfolio. So that means a bit more than 6% invested in each asset. So 1/16 of my money goes in each of those assets. So it means what I have now is I have my stock universe, I have a portfolio, and I will look at this portfolio in terms of assets and then in terms of factors. But again, the portfolio is just 1/16 of my money in Caterpillar, 1/16 of my money in American Express, and so on. So consider an equally weighted portfolio of the 16 stocks. I can calculate the volatility. I can actually, because these are just 16 stocks, I can take the variance covariance matrix V, and I can calculate the volatility of the portfolio, and the volatility of the portfolio is 24.6%. When I then actually look at that volatility of the portfolio and I look at the variances, I see that the variances of my stocks only explain 14% of the variance of my portfolio, and most of the portfolio risk comes from the variance. Let me explain this again. I mean, we have done this before, but it's so important that I say it again. Let me get the pen. The volatility of the portfolio will first be a sum of the volatilities of the assets, actually variances, plus then all these covariances, right? I, Y. And so actually most of the risk sits in here. Only, what did I say, 16%, 14% is here. Now, that doesn't tell us much. It just tells us, okay, there is a lot of covariance going on here. There's a lot of co-integration in this space. Erase, go to the next slide. Okay, this one we skip. I just wanted to show you, it's the same as we did before, but of course now the numbers get a little bit more numbery. I have more numbers. Before I had 5 stocks, now I have 16 stocks. And then I get again my matrix B, and you see my matrix B gets really, not ugly, but gets very, very, very big. But now, if I do that, if I look at my equally weighted stock portfolio, right? So that's my portfolio. You see the volatilities of my assets, and this is how much I invested in each asset. And I look at how this translates into the factor world. So my portfolio can now be thought of either as investing these amounts in stocks or investing these amounts in the factors. And you can already see some of the factors are very, very volatile. So I have one factor has a volatility of 114%. And now the cool thing, if I actually look at the variance of my portfolio, and I write the variance of my portfolio in terms of the factors, right? So here the factors. We know that the variance of the portfolio is a weighted sum of the variance of the factors. These are the variance of the factors. Now, these red numbers is what I have in this second column here. These are the variances of my factors multiplied by the beta. So these are those numbers. And what you can see, or you tell me what you can see. What I can see is that actually most of the variance of my portfolio here is in only these 2 or 3 factors. Actually, while I have 16 factors, 2 of these factors already explain 99.43% of the portfolio risk. So that means if I'm interested in diversified portfolios where a lot of company-specific risk is diversifying away, maybe I don't have to consider all the factors. Maybe a few factors is all I need. And that's what you can see. I would even argue here that 2 factors are already explaining 99.43% of the portfolio risk. So it's enough if you deal here, if you just choose here 2 factors. This is exactly where the risk reduction is happening. The risk reduction is happening here, where I just choose a number of factors to describe my risk, and I don't take all the factors. Cool. Yeah.
We have a question here I think would be good to play. So we have actually 2. One was an observation that while the asset weights add up to 100, the factor weights or the factor loadings do not. And I think it's important to note that they don't need to add up to 100, right? Because what we're trying to do is not to think in how much dollar is in dollar terms, but we think in risk terms. So it's actually the factor risks adds up to the to the total portfolio risk. That's how the factors sizes are scaled, so that the risk of the factors add up to the total portfolio risk, and not so that the dollar value of the factors adds up to the $100 we had at the beginning.
Yeah, but it is nevertheless the fact that if you invest $100 into your portfolio, so that means you invest 6.25 dollars in asset A, 1, 2, 3, 4, and so on. If you invest $6.25 in each one, and I say here that you would invest $21 in factor F1, etc., that in the end you spend the same amount of money, because some are negative, and not everything is so what I'm saying, if you really calculate how much money do you have in each asset, it comes to the same. So it still adds to 100.
And there was a second question, I think that's probably just coming, is to say, well, do we understand this factor, what they represent? And I think
that's a very good question. That is actually a fantastically good question, and I would like to show you. I would like to show you these factors now. So let me show you. I only show you these two factors. Remember, I said two factors are important. Let me show you the two factors. And let's at the moment concentrate on factor 1. So this, take the pen again. This is factor 1. And now you tell me what factor 1 is. Well, this is the problem. Nobody knows, right? And you see, this is how we started. We started from a risk description. We started with this variance covariance matrix, and we gave full power to the machine to find the best factors, the uncorrelated factors. Now, from a mathematical point of view, these factors are unique. So it's not that you can write it in many different ways. I mean, you can scale them. Of course, if you have a factor, 10 times the factor is still the same thing. It's just the leveraged or a little bit less leveraged. The problem when we go this way, and this way I called it statistical factors. Another way to call it is principal component analysis. The problem is exactly that these factors don't mean a lot to us. This is not a problem if you just want to get a good hedge or so. So if you're a hedger and you want to get a good hedge, you just want to get a good risk description. But if you are a return seeker, so if you also look at the return side, you want to understand the economic side, why this portfolio has this risk or why this portfolio merits this return. And this is completely difficult with principal components. And that's why in reality, and Vincent will show us that later, in reality, you do it slightly different. In reality, you often prescribe the factors and tell the system, do the best with those factors. I have an idea what the factors could be. So I tell you what these factors are. Now give me a description in these factors that I give to you, machine. This leads to a less good risk description, but a risk description we understand better. Coming back to my question, what could factor 1 be? And you now look at the weights of factor 1, right? So I have, by the way, I have ordered these weights according to the highest weight is at the top. So this is Bank of America, JP Morgan, American Express, General Electric, and you know that General Electric is more or less was a bank at that point as well. And you can see this is heavy in banks. And you can imagine this goes over to 2007 or 2008 credit crisis. Their bank was a risk factor. So you could say this is something like the risk factor bank plus. Or say the market tilted towards banks or so. This also shows us that probably if I would have done the same description, the same principal component analysis for a different period, where banks did not play that a significant role, I would most likely have received a different factor. So factors change, factor loadings change, beta change, as long as the structure of the market doesn't change too quickly, it still makes sense to take them. But probably right now, 5 years or 10 years later, these factors would not make a lot of sense anymore.